Welcome to the video where you'll find a reason cryptocurrencies move up, down, sideways, to the moon and back. I don't own any cryptocurrencies myself at the moment, but in the past I had some gamble money placed on Bitcoin and Ethereum. During the time I hodled them, they did nothing. Then I sold my wallet entirely the day I got bored of hodling, and ta-da, to the moon. But we're not here to discuss my investment plans or past portfolio returns. You are here because you want to understand what makes crypto markets move, and that's exactly what you'll find in this video. The first step is to give a little bit of background about what cryptos really are. For this video, we'll be focusing on Bitcoin. As I am no expert in blockchain or crypto, I think a great idea would be if we just research for Satoshi Nakatomo's paper, where he depicts his creation and its framework back in 2009 called Bitcoin. And I quote, "A purely peer-to-peer version of electronic cash would allow online payments to be sent directly from one party to another without going to a financial institution." Dope. What else does he have to say? Incentive. The first transaction in a block is a special transaction that starts a new coin owned by the creator of the block. This adds an incentive for nodes to support the network and provides a way to initially distribute coins into circulation, since there is no central authority to issue them. As in all of my videos, what you hear is my personal opinion, framed with the knowledge I've acquired throughout all my life, both academic and professional. I try always to stay unbiased and see things for what they are, impartially, regardless of how I feel about the story. What I understand Satoshi is explaining here is a transfer payment system, similar to PayPal, Visa, MasterCard, or Western Union. I do not see any reference to a store of value, or even hinting that those coins should have some sort of value, just because they will be coined to a finite number. He does compare it to gold miners though, with the only exception that coins are the reason, as explained in his paper, the network and its blocks will be kept running and online. So two questions are crucial to address the value of Bitcoin. One, what will happen when the supply of Bitcoin hits its top of 21 millions and rewards disappear to sustain the network? And two, given that states own the monopoly of violence and finance by issuing the legal tender currency and using it to collect taxes, and all the land in the world is privatized by country or individuals, will they reject that power to embrace Bitcoin? Fast answer to question number two, no, they won't. I also believe the whole concept of decentralization in a world with no free land makes poor sense, unless you go to space or Mars. Not so fast with question number one. Satoshi also states, "We define an electronic coin as a chain of digital signatures. Each owner transfers the coin to the next by digitally signing a hash of the previous transaction and the public key of the next owner and adding this to the end of the coin." So a Bitcoin is a chain of digital signatures used to make a transfer payment of real cash? At least that's my understanding. Well, now that we know more or less what Bitcoin is as explained by its creator Satoshi, we can make assumptions about the Bitcoin market. Like, number one, holding Bitcoin delivers no interest. Number two, no authority backs its supply or covers deposit loss if the clearinghouse fails. 3. The price of Bitcoin climbs when buyers are willing to pay a higher price for it. 4. There will be only 21 million Bitcoins ever mined, hence it's somewhat scarce. I mean, you can copy Bitcoin naming it something else and it can be 99.999% similar in every aspect of digital cash, especially in the part where you can't see it or touch it, unless you hodl inside a pen drive. Therefore, the only way you can make a profit of Bitcoin is by selling it at a higher price. So the first thing moving Bitcoin and crypto markets? Pump and dump whales. Like our beloved Elon Musk, who uses his Twitter account and promises of adoption by Tesla to manipulate the price of Bitcoin or Dogecoin. But ironically, his companies do not have any direct intervention into the crypto market. Tesla produces cars. They don't mine crypto or anything. It's true they have some Bitcoin in the balance sheet, but that is just one more buyer in the market. Yet why does the price still move? Because if Tesla says they will buy Bitcoin or accept it as a legal tender, you've got someone willing to buy at the higher price with presumably more cash than the rest. In a normal investment, it doesn't matter if you buy shares, real estate, or even a Rolex. You should care about scarcity and cash flows. Is Bitcoin scarce? Well, there will be only 21 million bitcoins mined, but the value added due to scarcity usually comes from an intrinsic irreplaceable characteristic, which is an equation of time value, quality of materials, and supply in the market. Bitcoin is completely reproducible, has no intrinsic value, and indeed there are hundreds of cryptocurrencies out there. So why does it go up? Reason number 2, speculation. That has to do a lot with our previous example of Tesla, as it has been widely reported downfalls in both Bitcoin and Tesla over the last 2 years have happened in the same time frame. Correlation among both assets is also at very high levels, meaning statistically they behave in the same way. Nonetheless, there is no doubt Bitcoin, just like other cryptocurrencies, have delivered stellar results over the last decade, and even the last year, far outpacing the S&P 500 or the Nasdaq. But these stellar results came in periods with exceptional increases in market liquidity, and subsequently big fallouts occurred when liquidity dried up. These are typical behaviors in speculative assets. When the plug of new money is pulled, the most risky and speculative assets are the ones to get hammered. Not always they fall in a straight vertical spiral as it happened in 2018, but depending on the magnitude and origin of new coming investors, the bear market might look much different. For instance, the 2017-2018 Bitcoin bubble popped after the Federal Reserve started decreasing its balance sheet of US assets, ergo draining liquidity, and hiking interest rates. It's hard to tell in which country we can find the most of the Bitcoin buyers, but it's reasonable to suggest back in 2017, most came from the US. Yet today, Bitcoin has drilled into many more countries across the globe, and even governments are holding some on their balance sheets. El Salvador is probably the most remarkable one. If there is something history has shown us from the past, is that speculative bubbles are fueled by vast amounts of liquidity. And given markets need a constant inflow of new bids and asks, as soon as those newcomers stop showing up, the bloodbath of falling prices commences. Given that today the Federal Reserve is close to lift rate with inflation at 40-year high and start reducing its balance sheet, investors must be cautious about hoping for stellar returns in the next years, like the ones they experienced in the short-term past. That's all for today, and be careful with your trading strategies. Bye.